Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor. Really happy to have Michael Oliver with me once again. It's Momentum and Structural Analysis is his newsletter. It's one of those letters that I couldn't afford not to have, and I'm so thankful for Michael and the work he does. Go to olivermsa.com to keep up with his latest objective views on the markets, because I think Michael really does let the markets tell him what's going on rather than him telling the markets what's going on, or telling his subscribers what's going on when he has no clue. Michael really lets the markets tell him what's happening, and I've seen it time and time again when he maybe would like to see a different direction of things, but he calls them as he sees them, and for that we're very thankful. Thanks for joining me again, Michael.
Hi, Jay. Good to be back.
Always good to have you. On October 23, you sent out a chart of TLT to your subscribers showing that this particular ETF that contains, I guess, 20 to 30-year U.S. Treasuries, that it had fallen back to levels not seen since the 2008-2009 financial crisis. Do you see this as kind of a floor for the Treasury markets at least for now?
Well, we had a downside target on T-bonds and TLT, which is the popular ETF of long-term government debt. And they got to the target zone a week or so ago and pierced through it. And we warned people, don't assume that our target zone is going to hold, because these are effectively crashing markets. They're not arm wrestling downtrends. They're markets that are out of control, basically. And even our Secretary of Treasury Yellen a couple of weeks ago said she was very concerned about illiquidity. That's one of the worst words you can use. One thing about going down, it's another about being illiquid. And when U.S. government bonds become illiquid in British and the Japanese, illiquidity is a word that is it's spooky. Anyway, so I think maybe we're reaching a panic level in those markets that could generate a stability or counter-trend rally. Okay, meaning a pause in the increase in rates. Okay. We're also seeing that sort of action in the dollar. The dollar, I think, is topping. In fact, its high price was a month ago, and we tried to make a new high this month, couldn't do it, and got slam dunked last Friday. We're now breaking through some levels that, frankly, if you close the week, we think you're adding to our indication of breakage. And we're not talking about a trading breakage, but a trading downturn that is the top of the rally. Okay. Now we've got some numbers below that have yet to be hit, and when we see those, we'll really think it's over. Now, those factors, a rally in the bonds and the downturn in the dollar, could take the pressure off of the Fed, and possibly it could be an indication, at least, that the Fed is going to soften up a bit or be less cute tightening. Okay. And there's a lot of economists out there who've been pounding the table saying, hey, you're going too far. Okay.
Right.
And even some Fed members, including the vice chair, Brainerd, said things to that effect. So I suspect that the market, the stock market, the gold market, a lot of markets that have been pressured by this Fed notion, the pressure's coming off of them. And so that's why you're getting a rally in silver and gold, and you're also getting a rally in the stock market. Now, don't confuse the two, okay? We applauded the rally in the stock market. In fact, last weekend we said we're coming up to at least this level. So we've had a good 2-3% rally since last week, and we thought it would happen. We're very pleased that October didn't turn into a disaster. I'm sick and tired of false notions of seasonals, particularly in financial markets, where, October's a disaster and then you can buy the world, okay? And then December's great, okay? It's, like the stock market is some kind of crop that comes out of the ground that has a seasonal tendency. No, it doesn't. It's a coin toss at best, those events. But anyway, so the October darkness didn't occur. And, maybe it'll be a dark Christmas, I don't know, but which would be also counter-seasonal. I don't trust a stock market rally based upon these factors or the assumption that the Fed is going to now start to slow down. I think the Fed will start to slow down because I think the factors that have been in play, such as a collapsing bond market here, UK, and Japan, and the strong dollar, which was exacerbated the situation, was a problem for them. And by cooling off a little bit or hinting that they might cool off helps to cool off those situations. So those markets effectively put pressure on the Fed to probably be authorized to make statements like Brainerd made.
You're right.
Or Yellen made about the illiquidity issue. So, but even if they do start to shift policy, and I think they will, because I think you're also going to soon start to get data points. Kind of data points they like to talk unemployment and all the fact production numbers and all kinds of things, things that they consider important, but are always lag data points to reality.
Yeah.
So, reality's already changed, just as those data points haven't caught up to it yet. But when we start to see that, that'll give the Fed some intellectual ammunition to say, oh, okay, well, we can now start to talk less about 0.75% raise. Well, maybe we'll go half or whatever. In other words, you start to see the other side. But I don't think that will sustain the stock market. And the reason I don't think it will sustain a stock market rally, it may help cause one, but the sustainable one I'm talking about, is we have a stock market bubble that broke. We have the biggest stock market bubble in U.S. history. You go back and look at the 1923 to 1929, look at the dot-com so-called bubble, look at the real estate bubble so-called from 2003 up to 2007. None of them compared to the percentage gain that the S&P produced between 2009 and 2021, sevenfold. NASDAQ 100, 16-fold. And we know the reason for it. It's largely monetary policy, QEs out the yin-yang, et cetera, et cetera. No wonder it went up. They created inflation, and it went into stock market, paper assets. But now those assets are broken. By our metrics, they're so broken that you want to have rallies, you can have all the rallies you want. You're not going to turn the beast around. It's broken. And therefore, the notion that you can buy stocks because of this possible change is a teaser. I don't think it's a teaser for gold and silver or for the downturn in the dollar. I think it will sustain. But for those who are buying stocks right now thinking the same reason that gold people are buying gold is that the Fed might change, yeah, that's a good assumption. But don't assume that the trend is going to continue in the stock market upside.
Yeah. So why do you see it happening in the gold market and say maybe the precious metals market and not in the equities market? Because the equities markets were so overpriced?
Well, yeah, and it's going to have real-world consequences. And in fact, a lot of people know that those real-world consequences are out there. They're already there. They just don't show up in some of the data points. CEOs of companies, heads of banks know, hey, there's a lot of bad stuff's going on out there. It's just not showing up in the Fed's data points yet. And once that reality dawns, and once it's realized that even though the Fed changes policy back to what they normally do, which is to say support assets that they have to support, especially U.S. government bonds, and it doesn't work, then desperation takes over. And, of course, once these data points turn, the Fed's going to have to go back to their other primary function, which is unemployment. And I suspect unemployment's going to change. Probably sharply at some point. Even that last unemployment report, if you scrutinize it very carefully, the biggest explosion in the numbers that was positive was hospitality and entertainment. Give me a break. Is that the core of the economy? Okay.
Well, sadly, it's much more of a core than it used to be in America when we produce things, but that's another story. But all right. So I noticed that GDX, one of your charts that you showed, I think it was last weekend, the daily chart looked sort of positive for GDX on the momentum chart. Looked fairly positive. How are you seeing?
The miners are looking good. I mean, if you actually put yourself in a short position. Let's say you went short back in July as this thing was starting to, well, actually it was breaking before then, but let's say you went short back in July. You're at best break even. July, August, Sep, almost November, okay? So there's been a lot of wheel spinning down here. We're really not going down, folks. Somebody's buying down here. And I think they've got good justification for it. Forget the charts even. I think they're not going to zero, guys, the mining sector. And you get GDX from the 40s down into the low 20s. and you see the brakes get applied, there's a reason for it. And also, when you see gold break its prior price lows that everybody can see, namely around 1670, and not fall apart, instead get back above them, weave back above and below. Right now, we're 1650. It's hardly falling apart. This is where gold was. Let me put it this way: we're a little more than 1% lower than we were in March of 2021. When it made a low at 1671. Okay, so somebody's buying down here, and I think there's good reason for it. And we've got numbers above the gold market, not far above, that will indicate that I'm really turned. But we're seeing the evidence first in silver and the miners. We're seeing, especially out of silver, the percent gain it's had over gold over the last couple of months has been important. It indicates to us, like as you were talking to your prior guest about silver outperforming gold, I think that's the case now.
Right. And of course, gold has done quite a lot better in terms of other currencies that are down vis-a-vis the dollar. So, and they've probably held their own in their own currencies against, probably have not lost much, if anything, in some. But it's the dollar, this quote-unquote strong dollar that's got everybody. Anyway, Michael, with just a couple of minutes left here, natural gas. One of the charts and one of the articles you wrote, you said something bizarre is going on in that market. That was October 23. And this morning, I heard that actually natural gas in some part of Texas is down to zero or something like that. Part of the reason that I understand is that Europe is now don't have any place to store the gas that we're sending over there. And so, the liquid natural gas. So I don't know what's going on, but what are your thoughts?
I think natural gas, we had numbers at 640 and 620. We didn't want to see 620 traded. And it did, and it dropped to the front month contract. This is November, which expires in several days. Dropped down into the 490s quickly. That's very cheap. Remember, it did $10 several months ago. So it got cut in half. Right now it's 560. It's up 8% today. I think it was largely a front month contract type event, and it is probably one of, like you pointed out, there's a temporary situation that is help drive it down. But when you go and look at the natural gas companies that are involved in the various phases of production and so forth, they didn't even dip. They had a good solid up week last week while natural gas was collapsing. Something was amiss there, meaning were the investors in the natural gas sector, the producing companies, stupid? Or do they know that this is just a temporary event? I'm going with them. Yeah. I think that natural gas overdid itself, and I suspect the low we saw a week ago is about the low you're going to see. Could very well be. And if you have to rebuild it, it'll have to rebuild itself, but still, I don't think it's going to trend lower than that.
All right, real quickly, Bitcoin.
Yeah, it's I suspect there's one more downside leg, and one that's like a total washout. Some people talking 10,000. I don't know about that, but we've tried to hold around 18,000 on Bitcoin, but it's gone dead asleep. If you look at the charts over the last couple of months, it's like, what happened here? We have an extremely volatile market. Now you can hardly draw the bars on it. It doesn't look like a low. I think there's one more down. Then after the next down, if you get down to 15,000 or whatever, I don't have exact number, but some further dramatic down, at that point, we're going to get a little more keen on looking for a bottom. Right now, I think it's premature. Yeah.
I just mentioned also a lot of other markets that you follow that we don't talk about. I noticed one on cattle. It looked very, very bullish, really taking off. And it's pushing toward all-time highs. And while you're saving money on your gasoline per gallon you're pumping in, you're losing about the same amount per month paying for beef. Right. Well, there we go. We're in an inflationary era, no doubt about it. All right, Michael, we'll have to leave it go at that. Thank you so much for spending time with us. It's greatly appreciated.
Thank you, Jay.